Hi, I want to provide you with an overview of asset pricing models. First, we're going to cover the capital assets pricing model, which is referred to as CAPM. Then we'll move on to talking about the Fama and French model, which is a three-factor model. The capital assets pricing model formula looks like this. It says the expected return on asset I is equal to the risk-free rate plus beta, which is a measure of risk for asset I, times the market risk premium. And this market risk premium is represented as RMRF. It's the expected return on the market minus the risk-free rate. There are various ways to estimate the beta or risk of a stock. But traditionally, analysts have taken 60 months of returns for a stock and regressed them on the market return. Oftentimes, the market return is proxied using the return on the S&P 500. When you regress the return on the stock, on the market, then you get a slope basically from that regression, and that's the beta, the risk measure. It represents how sensitive the expected return on a stock is to the return on the market. So this is a seminal piece. It won the Nobel Prize in economics. It really is sort of the starting point for asset pricing. Let's take a look at how well it works in practice. This is the model, this is the theory, but let's take a look at how it works in practice. We can form portfolios of stocks with similar betas and then examine the subsequent returns on those portfolios to see the relationship between the betas and the returns on the stocks. And in this case, we're forming portfolios of stocks, so we'll examine the return on the portfolios. CAPM says that the return should be a positive and linear function of beta. And so this graph formed using actual data does indeed seem to bear this out. You could actually fit a line that reasonably approximates the dots in this plot. So it actually seems that the model works. But the capital asset pricing model says that there's only one thing related to a stock that you need to know in order to estimate the expected return. There's only one asset-specific factor that you need to know, and that's beta. Other factors should add no value in estimating the expected return. You can see that from the equation, right? There's only one thing that's related to the stock. For stock I, there's only one factor on the right-hand side of the equation, and that's beta that is related to that stock I. So basically what that's saying is other factors should add no value in estimating the expected returns. Does this indeed work out in practice? If we examine historical data, does this work? Well, this lower plot adjusts the returns for the effects of size and book-to-market equity. After these factors are taken into account, there seems to be no relation between the expected return and the beta. This positive and linear relationship that CAPM predicts is actually gone. And you can see that from this lower plot. Try drawing a line to represent these dots. You can't do that anymore. There's basically a slope of 0 if you put a line in. There's no relationship here. So CAPM doesn't seem to work when you add these other factors in. Sometimes economists refer to the fact that beta is dead, and that is a way of describing this lower graph. After making these adjustments, there's no positive linear relationship between beta and subsequent returns. So hopefully this leads us into a famous paper that was written in 1992. It's the cross-section of expected returns by Eugene Fama and Kenneth French. This paper is one of the most widely cited papers in finance, so it's very important to know about it. And this is where the Fama and French three-factor model comes from. They argue that two easily measured variables, the size and the book-to-market, combine to capture the cross-sectional variation in average stock returns associated with market beta. size, leverage, book-to-market ratio, as well as the PE ratio. In fact, they argue that when tests are allowed for variation in beta that is unrelated to size, this relationship between beta and average return is flat. That's what's shown by this lower plot right here, where you're not going to have a linear relationship anymore. So these are the three factors. You've got the traditional factor associated with CAPM. You've got a factor associated with size. Size is a very vague term, but in this context, it's really talking about the market capitalization of a stock, the current market price times the number of shares outstanding. And so the third factor is this book-to-market equity. So let's take a look again at the CAPM formula. We're moving from this initial work that was done in asset pricing to the Fama French model, where we're adding on these two other factors. So now you have three betas. Three betas because there are three factors in this. The way that I would explain this is the expected return on asset I is equal to the risk-free rate plus the sensitivity of asset I to the market risk premium plus the sensitivity of asset I to SMB, which we'll define later, plus the sensitivity of asset I's return to HML. Again, we'll define that later. But you can think of SMB as being a measure of the size factor. You can think of HML as being a measure of whether a stock is a value stock or a growth stock, and that's brought into a factor. So let's talk about how these factors are created. Again, we've got the Fama French three-factor model equation at the top. SMB and HML factors are computed using 6 portfolios that are formed using the size and book to market. And I want you to know how these portfolios are formed because I feel like that this is essential to understanding how these factors are formed and how you can do this regression to calculate these betas. Ultimately, your goal is to come up with an expected return, this RI. And this expected return is obviously very important because we use these for all kinds of purposes. It's our discount rate when we're trying to look at future free cash flows and discount them back. So again, we're going to try and form 6 portfolios. And if you can remember this table right here, this will help you to understand how these 6 portfolios are formed. First, let's talk about this vertical line. What happens is you take all stocks out there and you rank them by the market value of equity. Using that, you are going to compute the median market value of equity. All stocks that are below this median market value of equity are characterized as small. All stocks above this median market value of equity are going to be characterized as big. This is a very simple way to classify small and big. There's no medium in this world. It's just everything half are small, half are big. Now let's talk about these 2 horizontal lines. We're going to rank all stocks according to the ratio of the book value of equity to the market value of equity. After ranking all these, we'll take the 70th percentile and the 30th percentile, and this is going to be very important percentiles. Those stocks that have a ratio above the 70th percentile are going to be characterized as value stocks. So we're going to have small value stocks as well as big value stocks. Those stocks that have a book to market equity ratio less than the 30th percentile, those are going to be growth stocks. Now, how do you think about this? I want you to think about this ratio, the book value of equity to the market value of equity. When something is of value, then that market price, the M here, is going to be low relative to what you're getting. And that's this book value of equity. You get the book value of equity when you buy part of the firm. So when M is low, it's going to give you a high ratio, and that's going to be indicative of a value stock. Now think about stocks that are growing their earnings in the future. Investors are willing to pay a high price for this growth in earnings. So the M is large relative to the B, and this ratio has a low value. Those that are below the 30th percentile are going to be those growth stocks. Those are the ones that are typically growing earnings in the future. So now that you know how we form these portfolios, let's talk about how we actually get the numbers to include in the regression. The way that we do this is by looking at the returns on these portfolios. The SMB factor is going to be the average return on three portfolios, the small value, small neutral, and small growth. And this is the S here, the small. And we look at the returns on these three portfolios, small value, small neutral, and small growth, and we average them. That's why it's multiplying by 1/3. This minus is the minus right here, and we're subtracting off the average return for the big portfolios. Big value, big neutral, and big growth. So it's taking small minus the big. How do we form the HML portfolios? Well, it's basically high minus low. And when it's, the question is, what's high, what's low? Well, we're looking at the ratio of the book to market, and those that are high are going to be the value ones. So we're taking the two value portfolios, big value and small value. We're averaging the returns on those portfolios. That's why we're multiplying by 1/2. Then the M is the minus. We're going to be subtracting the low book to market ratio stocks, and those are represented by the portfolios for small growth and big growth. And we're going to take the average for those. So again, it's high, the value stocks, M is the minus, the L is the low book to market stocks, and those are the growth stocks right here. So I've shown you a table out of the Fama French paper that was published in 1992, and I don't want you to obsess over these numbers, but I want to give you a feel for why they decided to add these additional factors. But I think this table does a really good job of summing it up, as well as giving you a background on the data they were using to publish this paper. They were looking at stocks from 1963 to 1990. So this is a fairly long period of time, but there could actually be more time in this. In terms of stocks that they're looking at stocks that trade on the New York Stock Exchange, the American Stock Exchange, and the NASDAQ. They want them to have historical pricing data as well as CompuStat data, and that means available accounting data. They take this and then they form portfolios based on the size breakpoints, and then they of course sort these stocks into portfolios based on their book to market ratios. So look at the tables. This table is showing the monthly return. So average monthly return is the time series average of the monthly equally weighted portfolio returns. There are lots of portfolios here, and they're giving you lots of monthly returns. So let's look at the columns first. All of these are book to market portfolios. So think about what it means to have a low book to market ratio. That's going to be a growth stock. Remember, the market value is going to be high because investors are paying for expected growth in earnings, and that's going to result in a low ratio. So as you move to the right, you're getting to these high book to market ratios, and those are the value stocks. Let's talk about the rows now. It's forming 10 portfolios based on the market capitalization. You've got small stocks, and those are the ones with the smallest market capitalizations, and you've got the large stocks, those with the largest market capitalizations. Things like GE, Apple, Exxon. Those are good examples of very large companies based on market capitalization. So where are the high average monthly returns? Remember, that's what we're looking at, the average monthly equally weighted portfolio returns. Over in this corner, you see that the average monthly returns are much higher than the other ones. The highlighted returns are the portfolios that are small value portfolios. These are the ones that are providing the highest returns, and this forms the motivation for basically estimating expected return using these three factors: the regular sensitivity to the market, what we commonly refer to as beta. Then there's SMB, which is size, and there's HML, which is book to market equity. Hope this helps you understand how the theory associated with asset pricing has evolved from CAPM to moving to these three-factor models.